Hello and welcome to our today's video on One Up on Wall Street book summary. This book is written by Peter Lynch, who is a legendary investor and former manager of the Fidelity Magellan Fund. In this video, we'll give you an overview of the book and the key takeaways you can apply to your own investing strategy. Chapter 1, Learn to Earn. The first chapter of the book emphasizes the importance of educating yourself about the stock market. Lynch encourages readers to do their own research and to be knowledgeable about the companies they invest in. He argues that investing is not gambling and that success in the stock market requires a solid understanding of the businesses you're investing in. Chapter 2, Preparing to Invest. In the second chapter, Lynch outlines the steps investors should take before investing in stocks. He suggests that investors should first pay off high-interest debt, build an emergency fund, and have a clear understanding of their financial goals. Once those steps are taken care of, Lynch recommends investing in a diversified portfolio of stocks. Chapter 3, Picking Winners. Chapter 3 is all about how to pick winning stocks. Lynch suggests looking for companies that are leaders in their industry, have a competitive advantage, and have a strong balance sheet. He also advises investors to pay attention to the price-to-earnings ratio, PE ratio, and to avoid investing in companies with high debt-to-equity ratios. Chapter 4, The 2-Minute Drill. Lynch suggests asking a few key questions about the company, such as whether it's a leader in its industry and whether it has a clear growth strategy. He also recommends looking at the company's financials and earnings reports. Chapter 5, 5 Categories of Stocks. In Chapter 5, Lynch outlines 5 categories of stocks that investors should be aware of. These categories include slow growers, stalwarts, fast growers, cyclical, and turnarounds. Each category has its own unique characteristics and requires a different approach to investing. Chapter 6, When to Sell. The final chapter of the book focuses on when to sell stocks. Lynch advises investors to sell when a company's fundamentals have changed or when the stock has become significantly overvalued. He also recommends selling if there's a better investment opportunity available. Here are 10 key takeaways from One Up on Wall Street by Peter Lynch. Invest in what you know. Lynch believes that individuals have a significant advantage over institutional investors because they can identify potential investment opportunities in their daily lives, such as products they use or companies they know well. Do your own research. Lynch stresses the importance of conducting thorough research on companies before investing in them. He encourages investors to look beyond financial statements and to study the company's products, competition, management team, and industry trends. Ignore market timing. Trying to time the market is a losing strategy. Lynch advocates for a long-term approach and recommends ignoring short-term fluctuations in the stock market. Look for stocks with favorable valuations. Lynch believes that the price-to-earnings ratio, PE ratio, is a critical metric for assessing the value of a stock. He suggests looking for companies with low PE ratios compared to their peers. Pay attention to insider buying. When insiders, such as company executives, buy shares of their own company, it can be a bullish sign. Lynch recommends keeping an eye on insider buying as a potential indicator of a company's future performance. Invest in companies with growth potential. Lynch advises investors to look for companies that have the potential to grow their earnings over time. He suggests considering companies in emerging industries or those with innovative products. Don't overlook small companies. Small companies can offer significant opportunities for growth, but they are often overlooked by institutional investors. Lynch suggests researching small companies that have the potential to become big players in their respective industries. Be patient. Lynch stresses the importance of patience when it comes to investing. He advises against making impulsive decisions based on short-term market movements and recommends holding on to investments for the long term. Be prepared to learn from mistakes. Even the best investors make mistakes. Lynch encourages investors to learn from their mistakes and to use them as opportunities to improve their investment strategies. Don't be afraid to be contrarian. Lynch recommends looking for opportunities in companies or industries that are out of favor with the market. Contrarian investing can be a way to find undervalued stocks that have potential. Thank you for watching.